Look, if you've glanced at a screen anywhere in the last few days, you know we are in the middle of a really intense, overwhelming news cycle right now.
Oh yeah, it's incredibly fast-paced.
Right, it's early March 2026,
Mm.
and the headlines coming out of the Middle East are just moving faster than most of us can even process. But here's the thing. When you are trying to understand what this actually means for your life, your wallet, and your portfolio, panic scrolling through social media is just, it's not going to help you.
No, it never does. It usually just makes the anxiety worse.
Exactly. And that is exactly why we are here. For this deep dive, our mission is to take a stack of really heavy, incredibly detailed macroeconomic research and market reports and translate them into a clear picture of how global conflict directly impacts your financial reality.
Because geopolitical shocks of this magnitude, I mean, they are never just news events happening on the other side of the world. They are profound financial ripples.
Right, they hit home.
They do. An event that starts as a headline immediately becomes a shift in global supply chains. It becomes a sudden fluctuation in the price you pay for gas, and it has a direct impact on those supposedly safe defensive stocks sitting quietly in your retirement account right now.
And we have some incredible source material on the desk today to help you cut through all that noise. We're looking at a comprehensive, brand new March 3rd macroeconomic report from Alliance Research.
Really solid data in that one.
It is. We also have a breakdown of the incredibly popular SCHD dividend ETF, and that's drawn from Ordiat AI and stock analysis, plus a dispatch from investing.com covering the sudden massive surge in drone and defense stocks. We're going to connect all these dots for you, completely jargon-free, so you can walk away from this deep dive feeling genuinely well-informed without all that information overload.
Right. We want to give you the framework to understand not just what is happening in the markets today, but why it is happening. What do the structural shifts look like underneath the surface? Because when you understand the architecture of the global economy, the daily headlines become a lot less intimidating.
Okay, let's unpack this. We need to establish exactly what the markets are reacting to. The facts on the ground are severe. We are looking at recent, direct, U.S. and Israeli military strikes on key military and civilian infrastructure targets in Iran.
And this is a major step up.
It really is. This is a significant escalation from that short-lived conflict we saw back in June of 2025. The U.S. has explicitly declared this involves major combat operations. The strikes resulted in the deaths of Supreme Leader Ayatollah Ali Khamenei, as well as multiple senior Islamic Revolutionary Guard Corps officials, the IRGC.
And Iran's response was immediate.
Yes, in retaliation, Iran has targeted U.S. military infrastructure in the Gulf. And just to pause here, because obviously these are highly charged global events, our goal today isn't to weigh in on the politics or the morality of the conflict.
Absolutely not.
We are strictly looking at the cold, hard math from the Alliance report to see how these events hit the global economy and your portfolio. We are just the messengers for the data. We take no sides here.
Right, because when markets process an event like this, they immediately strip away the politics. They look for the economic transmission mechanism. They look for the lever that moves the money.
The choke points.
Exactly. And in this specific conflict, that mechanism is geography, specifically the Strait of Hormuz. That is the ultimate choke point. To understand why this matters to your wallet, you have to understand this narrow stretch of water.
Give us the numbers on that, because they're staggering.
Roughly 20 million barrels of crude oil and about 30% of all global seaborne hydrocarbons, meaning oil and liquefied natural gas, pass through that strait every single day.
It is the jugular vein of the global energy market. And the Alliance report paints such a vivid, almost cinematic detail of what is happening there right now. Crossings through the strait have plummeted by over 70% following the attacks.
70%, just frozen.
Right. Major shipping lines are avoiding it entirely. Right this minute, there are more than 200 oil and LNG vessels just sitting at anchor, idling outside the strait. The IRGC has been broadcasting warnings over marine radio to commercial vessels, and even if they aren't boarding every single ship, the war risk insurance premiums have absolutely skyrocketed.
Which causes a massive precautionary pause. Imagine the only major highway out of your city during rush hour, and someone just parked a military tank horizontally across all 3 lanes.
Nobody is moving.
Right, nobody is necessarily getting shot at, but nobody is driving past it either. That is the Strait of Hormuz right now, which leads directly to the immediate market reaction we saw. The moment the markets opened on March 2nd, oil spiked 13%, hitting about $82 a barrel.
But wait, let me ask a stupid question here. Is there actually an oil shortage right now, or is this just people panicking?
That is the crucial nuance you need to understand, and it is not a stupid question at all. That price spike was almost entirely driven by maritime disruption and fear.
So it's about the boats, not the wells.
Exactly. It was driven by those 200 ships sitting at anchor and the astronomical cost of insurance. It was not driven by actual physical scarcity at the oil fields. The oil is still physically there, and global stockpiles are currently high enough to buffer the immediate shock. The market is pricing in the risk of delivery, not the loss of supply.
So it's the panic of what if, rather than the reality of the tanks being empty. Which brings us to the biggest question everyone has right now. How long is this going to last? Because if that highway stays blocked, eventually the gas stations do run dry.
What's fascinating here is how the analysts at Allianz have modeled this out into 3 distinct timelines, because duration is the single biggest variable for the global economy right now.
Okay, let's hear them.
Let's look at scenario 1, which they classify as the baseline, or the highest probability outcome. In this scenario, the heavy conflict lasts less than 4 weeks. It essentially ends with some sort of rapid power transition in Iran.
And what happens to the markets in that 4-week window?
If this holds true, oil might briefly peak at $85 a barrel as the headlines peak, but it would actually settle back down to around $70 by the end of 2026.
So in that scenario, what does that mean for the broader economy? Are we looking at another massive wave of inflation?
The macro impact in that baseline scenario is incredibly contained. We would only be looking at a tiny bump in inflation, maybe 0.1 to 0.2 percentage points globally.
It's barely a ripple.
Right. It wouldn't be enough to fundamentally alter central bank policies. The Federal Reserve would likely hold interest rates steady at 3.5%, and the European Central Bank would stay at 2.0%. It is a sudden volatility shock, sure, but it is not a structural break in the global economy.
And there's a fascinating political context to this baseline scenario that Allianz points out. And again, purely reporting the analyst's view here. They note that the current U.S. administration, under President Trump, actually has a massive incentive to bring this conflict to a conclusion quickly.
Because of the upcoming elections.
Exactly. If this drags on and higher oil prices start seriously worsening the affordability crisis for everyday Americans, it could severely hurt the administration's support heading into the November midterm elections. The analysts see that political calendar as a driving force toward a faster resolution.
Economics and politics are deeply intertwined, and market analysts always factor in those incentives. But as an investor, you have to look at the other side of the coin. What happens if the baseline is wrong?
Right, the longer timelines.
Scenario 2 is the prolonged conflict. This is where the Strait of Hormuz stays blocked or heavily restricted for months, not weeks. In that world, oil pushes up to $100 a barrel and inflation rises by 0.5 percentage point.
Which is enough to make the central banks sweat.
Definitely. That starts to make central banks very nervous, and borrowing costs stay higher for longer.
And then there is scenario 3, the tail risk. This is the one that really caught my eye in the Allianz report.
The tail risk is a low probability but extremely severe outcome. This is a scenario where the conflict escalates into long, sustained destruction of regional oil infrastructure.
So not just ships idling.
No, we are no longer just talking about ships waiting for insurance clearance. We are talking about the actual physical capacity to produce oil being taken offline. In that timeline, Brent crude rockets up to $130 a barrel.
Wow. And the fallout from that.
It's dramatic. U.S. equities could plunge by 20%, and the Federal Reserve would be forced to hike interest rates up to 4.0% just to fight off a massive second wave of energy inflation.
You highlighted a really nuanced point from the research regarding this worst-case scenario before we started recording, and it involves the plumbing of the global financial system and the new chairman of the Federal Reserve, Kevin Warsh.
Yes, this is a vital detail for understanding global liquidity. When a crisis of this magnitude hits, there's a massive global rush for U.S. dollars. People, foreign companies, allied countries, they all want the safety of the dollar, especially because they need to buy energy, which is priced in dollars.
The ultimate safe haven.
Right. And this causes the exchange rate, specifically the Euro-USD basis, to widen dramatically.
Wait, for those of us who aren't Forex traders, what exactly does a widening USD basis mean in plain English? Why does a rush for dollars break the plumbing?
Think of it like a sudden shortage of the world's most important currency. If you were a European bank and you desperately need U.S. dollars to fund operations or buy commodities, but no one wants to lend them to you because everyone is hoarding cash in a crisis, the cost to convert those euros into dollars skyrocket.
Supply and demand.
Exactly. That extra premium you have to pay is the widening basis. Historically, when this happens, the Federal Reserve steps in and opens up what are called swap lines with other central banks, like the European Central Bank.
And a swap line is basically what? Central bank overdraft protection.
That is a perfect way to describe it. It is an emergency pipe. The Fed pumps billions of US dollars into the ECB, and the ECB distributes those dollars to European banks to calm the panic. They did this aggressively during the 2008 financial crisis and the 2020 COVID crash.
But Allianz thinks this time might be different under Warsh.
Right. The Allianz report suggests that Kevin Warsh might be far more reluctant to extend those swap lines than his predecessors. He might view it as bailing out foreign institutions.
Which changes the whole game.
If he holds back and keeps that emergency pipe closed, European banks and global dealers could face a severe funding gap. It takes a regional energy crisis and mutates it into a potential global liquidity crisis.
That is exactly the kind of structural risk that doesn't make the evening news, but fundamentally drives the markets. So if that is the nightmare scenario for the global banking plumbing, how is Wall Street actually trading this reality today? Because looking at these investing.com dispatches we have, the stock market isn't just sitting around waiting to see what the Fed does. Certain sectors are already exploding.
Oh, the reaction in defense and aerospace equities was immediate. The market is repricing the sector based on the reality of the headlines.
And we are looking at some wild numbers. The surge in drone stocks specifically is just unbelievable. Just on Monday, March 2nd, Red Cat Holdings soared 26% in a single day.
26% is a massive jump.
It is. AeroVironment jumped 17% to hit a one-month high. A company called NRIHAT, which makes high-power lasers for aerospace and defense, gained 14% and hit record highs. Even niche companies, like Unusual Machines, they make ultra-low latency video goggles for drone pilots, they went up 11%. But hold on, if a stock like Red Cat already jumped 26% in a single day, isn't that trade already over? I mean, why should a regular investor care about a spike that already happened? Didn't we miss the boat?
It is so tempting to look at a single-day pop and think the story is over. But what you are seeing there is the market rapidly waking up to a structural reality of modern warfare.
A paradigm shift.
Exactly. Over the last few years, the nature of combat has fundamentally shifted toward unmanned systems, low-cost drone swarms, and the specific electronic countermeasures required to defeat them. Investors recognize that regardless of whether this specific conflict ends in 4 weeks or 4 months, global defense budgets are going to be heavily and permanently reallocated toward these specific technologies for the next decade.
So it is less about this one specific battle and more about militaries around the world realizing they need to update their shopping lists.
Exactly. And it wasn't just the flashy tech startups making moves either.
Right, the prime contractors too.
Yes, massive companies like Lockheed Martin and RTX, they both climbed over 3%. When a major geopolitical shock occurs, institutional capital looks for safe havens that actively benefit from the deployment of government resources. Defense is the most obvious structural winner here. But the Allianz report highlights other winners and losers that might not be as obvious to the casual observer.
I noticed that. The report calls infrastructure a massive winner, predicting potentially 10% returns. Why is a block straight in the Middle East good for a company building a power grid in the U.S.?
Because energy security instantly becomes a matter of national survival, not just economic policy. Capital that was slowly moving toward things like domestic power grids, non-Gulf liquid natural gas terminals, and pipeline diversification is suddenly going to be fast-tracked by governments.
The urgency just goes through the roof.
Right. The valuations of those infrastructure assets go up because their strategic importance just skyrocketed. On the flip side, you have structural losers. Airlines are highly exposed because jet fuel costs are surging.
And airlines can't exactly call up a customer who bought a ticket 3 months ago and say, hey, we need another $50 for fuel.
Exactly. They have to absorb that cost, which destroys their profit margins. Petrochemical producers also suffer because the raw hydrocarbon materials they use to make plastics and chemicals are suddenly much more expensive, squeezing them from the supply side.
Here's where it gets really interesting, especially for you if you're listening to this and holding what you think is a standard conservative retirement portfolio. Let's look at one of the most popular investment vehicles out there right now, the Schwab U.S. Dividend Equity ETF, ticker symbol SCHD.
A staple for so many investors.
It is. This is a fund famous for being steady, reliable, and, frankly, a little boring. SCHD is the kind of fund your grandfather buys so he can sleep at night. So how does a boring dividend fund behave during a massive Middle East war?
It actually transforms into an absolute powerhouse. And to understand why, you have to look under the hood at the fund's mechanics and the specific companies it holds.
I was looking at the breakdown of the SCHD fund from Orient AI and Stock Analysis, and my jaw dropped. First off, this fund is a monster. It has over $84 billion in assets. But wait, before we get to the holdings, it says it has a 0.060% expense ratio and a 3.42% SEC yield. Can you translate that into plain English for us?
Sure. An expense ratio is simply the management fee you pay to own the fund. At 0.060%, it is incredibly cheap. You are paying pennies for every $100 invested. The SEC yield is a standardized snapshot of the dividend income the fund pays out to its investors, annualized based on the last 30 days.
Very solid numbers.
Yeah, so it is a cheap fund that pays a solid 3.42% cash yield. It tracks something called the Dow Jones U.S. Dividend 100 Index.
And that index is where the magic happens. They actually just did a 3-for-1 stock split back in October of 2024 to keep the share price accessible. Now, the top 10 holdings of this fund make up over 40% of its total assets. So whatever those 10 companies are doing, the fund is doing.
Right, it's highly concentrated at the top.
And the number one holding, it's Lockheed Martin, sitting at a 4.88% weight. That is $4.1 billion of this boring conservative fund's money invested directly in a massive defense giant. How does a conservative dividend fund accidentally become a massive defense play?
If we connect this to the bigger picture, it becomes clear why SCHD is so perfectly positioned for this specific geopolitical shock. It is a rules-based index. It looks for companies with a history of paying consistent dividends, strong fundamental cash flows, and value pricing.
And defense fits that bill perfectly.
Exactly. Defense contractors, by their very nature, have massive long-term government contracts. That guarantees cash flow, which funds steady dividends. So the algorithm naturally scoops them up. Yes, its top holding is Lockheed Martin, which we already established is surging, but look at the rest of the portfolio.
The energy mix is wild.
The fund is nearly 20% weighted in the energy sector, and importantly, it is heavily weighted in non-Gulf energy producers. Its fourth and fifth largest holdings are Chevron at 4.46% and ConocoPhillips at 4.53%.
And as the Alliance report pointed out, non-Gulf energy producers are the biggest winners of an oil price spike. They get all the financial benefit of higher oil prices without the geographic risk of having their infrastructure blown up or their ships blocked in a strait.
The fund captures the upside of the energy shock, but it is also deeply defensive in ways that protect against broader economic slowdowns. It is heavily weighted in healthcare, with giants like Bristol-Myers Squibb and Merck.
The staples of life.
Right. It holds massive positions in consumer staples like Coca-Cola, PepsiCo, and Altria. These are companies that sell things people buy regardless of what the economy is doing or what is happening in the Middle East.
This is the real aha moment for your portfolio. You might have bought a broad, value-focused dividend ETF like SCHD just to collect a 3.4% yield and ignore the news.
Yeah.
But because of its specific rules-based methodology, hunting for fundamental strength and sustainable cash flows, you are inadvertently holding a portfolio that is heavily fortified with the exact sectors that are surging right now.
It's beautifully designed for a moment like this.
You are holding defense, you are holding non-Gulf energy, and you are holding recession-resistant staples. Grandpa's boring fund is practically custom-built for a crisis in the Strait of Hormuz.
It really demonstrates the power of underlying fundamentals. When you buy a broad index or ETF, you aren't just buying a 3- or 4-letter ticker symbol. You are buying a specific allocation of the global economy. And in this case, that allocation happens to perfectly mirror the structural winners of the current macroeconomic environment.
So what does this all mean? We have covered a massive amount of ground today. We started with a sudden, violent geopolitical shock in the Strait of Hormuz. We looked at how that immediately translates into fear in the energy markets, 200 idling ships, and potential global inflation risks.
We covered those 3 crucial timelines, too.
Yes. We broke down the scenarios for how long this lasts and how a rush for U.S. dollars could test the plumbing of the global banking system. We saw how the modern realities of conflict caused drone stocks to jump double digits overnight. And finally, we looked under the hood of a massive dividend ETF to see how global events directly lift the value of the assets sitting in your retirement account. It is all connected. And by understanding the massive macro forces at play, you can avoid panicking about the day-to-day micro fluctuations in your own portfolio.
This raises an important question, though, and it is the question the Alliance analysts pose at the very end of their report for investors to seriously consider. If this conflict drags on and we enter scenario 2 or 3 with a prolonged period of high oil prices, the global economy shifts. We move into a regime of supply-driven inflation.
Which feels very different from what we went through recently.
It is very different from the demand-driven inflation we saw a few years ago when everyone was spending stimulus checks.
Mhm.
Supply-driven inflation crushes economic growth while simultaneously raising prices. And historically, when that happens, traditional nominal bonds, the standard fixed-rate bonds that most people hold for safety, lose their ability to act as a hedge against equity losses.
They stop working as the shock absorber.
Exactly. Because inflation eats their fixed returns, they fall at the exact same time stocks fall, just like we saw in 2022. So the question you need to explore on your own as you look at your portfolio is this. If traditional bonds can no longer protect you from a geopolitical supply shock, is it time to start looking at inflation-linked instruments or perhaps hard infrastructure assets to protect your wealth over the next decade?
That is exactly the kind of critical thinking that separates reactive investors from prepared ones. You're now officially the most well-informed person in the room on what is really driving the markets this week. Thank you so much for joining us on this deep dive. Stay curious, stay informed, and we will catch you next time.